All right. So please note that yesterday there was another video uploaded on order on the selection of the stop. Okay, that topic has been covered many times, but since it's a very important topic for you to understand logically how stops are decided in technical trading using a very simple definition of the trend. So everybody should have already been subscribed to the channel and click the notification bell so that I could upload a video at any point of time. I'm not going to separately inform you by WhatsApp or whatever, right? So you should already be subscribed to the channel with the notification and set up for notifications. So whenever I upload a video, you should be able to get wind of that. Is that clear? So that will not be, you have to watch that video and understand that for yourself. Okay, so that is treated as an extension of yesterday's class. All right, make sure you understand it. It's been discussed before, but it's a very important point. So it's important and it'll give you a very it covers a very important foundation of technical trading. That is how to set the stop, and as I said, the risk management aspect of it is the most important thing. Okay. So as I said, so technical trading is very simple. Okay, the way I've taught you to approach it, because we have this problem with the project right now because we don't have time to cover the entire body of fundamental analysis. Okay, so there are two broad approaches that you can take. You guys have heard these terms, fundamentals and technicals. Have I covered it with you guys before? That fundamental analysis, we normally look at earnings and GDP and inflation. We haven't covered it. Okay, so there are these two broad approaches. Okay, we are coming to that. Okay, we will come to that when we look at the decision problems. But the point is basically what you're doing now. Okay, I won't even cover fundamentals now, except to tell you that the coverage of fundamentals will take a lot of time. Okay, so it's a very vast area and it'll take a lot of time. So, and because we have this time pressure of the project, so I want to just quickly give you some basic skills with which you can implement the project without feeling completely lost. Okay, so that's why for the purposes of this project, okay, as far as what I'm teaching you is concerned, okay, we are just going to look at I'm just going to initially equip you only with the toolkit of technical analysis, which actually is a very simple approach. So I'm teaching you a very simple way to approach the market. At the same time, it's quite a powerful method. Okay, it's a powerful method, and if you can learn to implement it properly, it's a simple and powerful method. Okay, and you can easily implement it even for managing large amounts of money in the real world. Okay, so it's not something to be laughed at just because it seems like it's a very simple thing. Okay, so in that context, obviously, what is the most important thing that second video from yesterday, what it deals with is what is the logic for selecting the stop. Okay, so understand that video properly, and the most important thing in trading, whether you trade from a fundamental or technical perspective, is risk management. Okay, because the models are all very fallible. So the way you are able to manage your risk, you understood what risk management is by now. Okay, that when I looked at, if we go back to that example that I've given you, where I was buying that TCS stock. Okay, all right, so I bought the stock somewhere around here. And what is the risk management aspect of it? Risk management essentially means the way I ensure my risk management program ensures that I don't lose everything on one trade. Okay, so I basically control the amount of money you lose, because one of the big problems that many people have, which you guys have also experienced firsthand, that you got into a position without pre-planning your risk. You haven't thought about what you're going to do. This is how most amateur investors invest, that they first just go in and buy or sell whatever they want to do. Okay, usually they go from the long side, so they go and buy some stuff. Okay, and usually they're operating in equity markets, so they go and buy stock, but they have no plan for what they're going to do if things don't go according to plan. Okay, if it moves in your favor, that's fine. You can sit and enjoy the profits. Okay, but you need a plan for that as well. But the more important plan is what you're going to do when it goes against you. Okay, so like a lot of you have been saying that the stock market has been dropping lately and you're buying stocks and facing losses, right? So this is the heart of what risk management is all about. What do you do when you when you start losing money on your positions? Okay, so what I did here, if you saw, when I decided to buy TCS, okay, as Aurora was asking, why did you decide to buy? That's a simple question. I just assume that simple answer to that question is, I assume that this trend is still in continuing. But the most important thing I did was that as soon as I bought it here, I also placed a stop over here. Okay, which means that on a per share basis, let's say I bought it around 2100, okay, roughly, and this is around 2028. Okay, so that means I can only lose about 80, okay, 72 rupees per share, okay, on this position. So now you see the beauty of this. If you can trade in this manner, always, this is a golden rule of trading, okay, that you must pre-plan your risk. If you do this, it may seem like you're following a very simple method, but it's a very powerful method, and the market can never really do much damage to you, because you're always under control. Your losses are always within budget. Okay, so you have a budgeted risk capital at the beginning of the period, and you carve it up. We will discuss the details of that, but the idea, I think, should be clear to everybody, that I'm not out of control here, because I can control my exit, I control my entry, I control my exit, and thereby I control my maximum loss. You can see that here, unless there is a massive amount of market turmoil, and what I'm trying to sell at 2028, it actually gets sold only at 1900 or something, which is not going to happen in a liquid market. Okay, so I will be out reasonably around 2028. Okay, at around this level, whatever this low is. Okay, so you can see clearly that I have therefore limited my loss on this trade to, my worst case on this trade is 72 rupees per share. Is that clear? So you should be able to appreciate the power of that kind of approach. Okay, that you are just making bets, and even if you assume that your bets are just 50-50, okay, that your hit rate is only 50-50, even if you assume that. Okay, so even then, you can't really, so on half your trades, as you assume that you'll win, and we'll come to how much you make on winning, on your winning trades. But the point is that you have limited the loss on your losing trades. This is clear? So this is a very powerful and absolutely essential approach to trading. In fact, many professional managers also don't do this. That's why they end up losing large amounts of money. Okay, so this actually, what I'm teaching you, it seems like it's a very simple thing, because I'm just telling you to look at this thing as if you're surfing waves. Okay, it seems like you're not applying any sophisticated mathematical model or anything, but it's a very sophisticated approach, simply because you're limiting the loss on each trade. Okay, and on the other 50%, roughly, let's say, assume on your winning trades, okay, you can make whatever money you can make. Okay, there are ways to manage that as well. So is this point clear to everybody? So understand the logic behind how the stops are set. Okay, it's a very powerful method, and most important element of this, of course, as I said, is the heart of all kinds of trading, not just trading to manage a risk, active risk book like what your asset manager, like a speculative book. Okay, but even for a corporate treasury, which is hedging its risk, like Air India is exposed to oil prices. Okay, so if oil prices go up, is it good for Air India or bad for Air India? Bad for Air India. Okay, because one of the things, you'll do a risk management case in your second course. Okay, the general thumb rule all over the world, okay, is that about 50% of the operating cost of any airline is fuel costs. Okay, and the jet fuel costs are very close. Jet fuel prices are very closely linked to crude oil prices. Okay, jet fuel is actually kerosene, so it is a derivative of crude oil. It comes from processing of crude oil, but the prices are very closely linked. So if you have a dramatic rise in crude oil prices, it's very unlikely that jet fuel prices will also not go up a hell of a lot. Okay, so therefore one major risk for many airlines is oil prices. Okay, so even when Air India is managing its risk, even there, this concept of the stop loss, okay, it has to be applied in a slightly different way. Even this concept of risk management still applies even there. Okay, so it applies in all kinds of finance roles that you will face. Okay, so it's very important to understand this. But unfortunately, in the traditional approach to teaching finance, this kind of thing is not emphasized. But in the real world, this is the key to survival. Okay, the key to survival in the real world is this business of risk management. So one of the great traders, system traders, the guy called Ed Seykota, he was asked about the golden rules of trading. You can look up this book. There's a book called Market Wizards. You'll find the PDF, I'm sure, on the internet. There's a famous book called The Market Wizards by Jack Schwager, and he interviews one guy called Ed Seykota, who was one of the great system traders. So he was asked about the 3 golden rules of trading. So his answer was cut losses, then cut losses. Okay, so this is the heart of survival in this business. Okay, because if you can manage, see, basically the idea is that if you can manage to limit the losses on your losing trades, okay, eventually you'll have some winning trades and you can maximize your profits on those trades. Okay, and we'll talk about how to do that. But the most important reason why most people fail, or most investors get into all kinds of problems, and they lose control over the process. Okay, they lose control over the process because they are not controlling their risk per trade in a highly disciplined manner. Okay, so this is clear, so make sure you understand this logic. All right, okay, so we go into we're just going to continue here with so I put this yesterday. We were discussing these the last point we were discussing yesterday was basically we looked at market depth and all that, and we were looking at spoofing and layering. Today, since we have the benefit of the internet, let me show you a nice example of market depth. Let's look at an active market like the euro. Okay, just right click. You can do this. Actually, you can get it even for your NSE stocks. So you might have fun with NSE stocks because your project trading period is quite low. I mean, it's quite short. Okay, so in that case, therefore, it kind of puts you into a short-term trading framework. Okay, in some ways. Okay, so you can even try this with your NSE stocks, but I want to show you some more actively traded markets. So let's just right click on the euro. Okay, so when you right click, they've already got book trader because I've used book trader before, but let me just go through the more general route. Go to trading tools, then you go to book trader. Okay, now here you can see again the euro order book. Yesterday we discussed the euro order book. I mean, we discussed order books. So I'm now giving you a very visual picture of the order book. Okay, can you see the stuff here? So you can see here, basically this is your top of the book here. Okay, this 34 half, this kind of this is your bid ask. You can see that. Okay, and 34 half. It's moving so fast you can actually, I can't even call it out. You can see what's happening here. It's the same concept here. You can see all the bids lined up on one side. As yesterday I had just done them in two columns on the board. Okay, but this is basically almost in one column because the prices are all in one column. Okay, so on the left side you see here, you see the bid sizes, and this is what I was showing you yesterday. Okay, there's a price and there's a size. So somebody is bidding for 14 million at 11.34. Okay, somebody now bidding for 13 million. May not be somebody, but this is the aggregate of all the orders. So you get the option of basically under this 12 million or 13 million on the bid side. Now there could be 10 people putting this, basically there could be 10 people bidding at 11.34, but the broker is showing you the 11.34 because you can hit that 11.34 for 12 million. There's a total of 12 million of bids over there. Alright, this is clear to everybody? Same thing, now you're seeing a live example. You can play with your NSE stocks also and see the market depth, and this is where you get into what Garvit was talking about yesterday, that you can look at this and try to assess what is the whether the pressure, the short-term pressure in the market is to the upside or to the downside. Are you following? You try to see, okay, then are there more orders on the sell side, or are there more orders on the buy side? Are there more offers or the more bids? Okay, so from that, if you see, obviously if you see more bids, that means the short-term market is strong or weak. The short-term market is more inclined to be strong, right? Because there are more bids. You see higher volume of bids. Okay. So and on the other, of course, the other side, the reverse conclusion would follow. Okay. So and from here you try to basically play around in the short term. Okay, and try to adjust your prices if you're a market maker, etc. Okay. So this is the idea. And then we talked about spoofing and layering yesterday. Okay. So that article actually doesn't define layering very well. It doesn't define it properly. It's because people are not very careful in the way they use the language. But spoofing, essentially all that it means is, see, now the prices are here, okay, and let's assume that there's not that much difference here. So suppose here, instead of putting 3.1 million, I put 100 billion sell order. Suppose actually I want to buy, okay, this is already explained in the article. I'll just briefly explain it. Spoofing, what we are doing is, here this is where the market is, okay, this is where the market is, but what I want to do is, I want to buy, but I want to deceive people. I want to scare the market and push the price down. Okay, so what I'll do is I'll put like a 100 billion sell order here, okay, maybe 100 billion sell order here, okay, very close to the market. So when people see that, people get scared. They think that, oh my God, there are so many sell orders. Okay, then what they do is, those who want to sell, those who are inclined to sell, okay, or those who need to sell, they see those big sell orders and they get nervous and they quickly sell, okay. So that pushes the price down. And then what I do is, then when the price goes down, say to 1132 or some 1132 or so at this level, okay, because the people who are inclined to sell, they see those big offer sizes and they get scared, and then they start selling and they pushes the price down. And then I put in a bid at 1132 and I buy, let's say, a much smaller amount that I wanted to buy. And then as soon as I buy this stuff, or just before that, I cancel all my sell orders. Are you following?
Yes.
Okay, so this is what spoofing is. Okay, so I cancel all my sell orders. So yeah.
What is the order gets executed?
Yeah, so very good point. So this is why if you read that article, so then the question that will arise is that this is where the policy debate comes in again. Okay, that the question is, so if you see that it talks about that guy Narendra Sarao I told you about. There's a guy who was spoofing the S&P 500 futures contracts. Okay, so he was so you've understood what spoofing is, and layering is nothing but spoofing at many levels. Okay, so layering is just spoofing at multiple levels. He's not explained it very well in the article, okay, but that's what it is basically. He says it, but then he again writes some confusing sentences. But so this guy Narendra Sarao, when he's been charged by the DOJ because the new rules in the US now, spoofing is a crime. Okay, so now the question is basically, if you see that writer in that particular article, okay, he actually says, if you see this article, so he actually gives an opinion. So the question of course can arise, because this is a fairly new rule in the US, okay, which makes spoofing a crime. So he's actually talking about, this is that Indian origin trader, okay. So this question is, should this be illegal? Okay, so this is a policy question. You should be able to engage in a debate, which is what actually Sakshi is hinting at. The question that she's asking: what if that order gets executed? What Sakshi is saying is, I put in a lot of offers. I put in a lot of offers with very high volumes. Okay, just above the market. Okay, thinking that I'll scare the market. But what she's saying is, what if before you can carry out your devious scheme, some guy comes and takes all your offers, because you are offered to sell. Okay, so somebody can come in and easily buy your stuff because you have put in those offers. Okay, suddenly, because the markets can move very dramatically. Okay, there's no guarantee that it will necessarily move in a steady manner. Okay, markets can move very dramatically. Okay, so therefore, what she's asking is and that's a real risk. Okay, so if you see that observation actually goes to the heart of this policy debate, that should this be illegal? You should understand this debate also. Okay, that should this question, now everybody understands what spoofing is. Is everyone clear about that? Okay, Surbi and Shivam, what are you doing here? So let's move Surbi somewhere else, so that she cannot communicate with him. Come and sit next to Tarun. So it's easier for her to move. No, she's on the outside. Let her move here. Okay. Now, one sec. So what was I saying? Yeah, so everyone understands. You need to understand this debate. You need to understand this properly. So everyone knows what spoofing is now. It's essentially you're placing an order to basically scare other traders in the market and cause some kind of price movement, but you have no intention of executing those orders. Okay, so the question now is, as this guy Narendra Sarao is being prosecuted for spoofing, which is now a crime, but the policy debate can always arise: should this be a crime in the first place? Okay, is this a problem for the marketplace? All right. So what this guy, if you see this writer of this CNBC article, okay, he's actually saying that it should not be a crime because of what Sakshi has pointed out, that there is always a risk that just when you put up these big offers which you have no intention of executing, somebody can immediately lift those offers, because if markets can move very dramatically, you don't know who can come into the market at what point of time. Okay, so this is where, so I would also agree with the CNBC article writer's view that this should not be illegal, because you are taking a risk. When you do this, you are taking a risk, especially if the market is actually a free and unregulated market. So remember, what happens is the general principle which you should try and understand, which is something that even Gulati was talking about yesterday, that he was taking off on what Garvit was saying, that how can you influence the market in a way, and he was actually hinting that that would be unethical. You can influence the market by putting prices, etc. Okay, or by buying stuff. He was actually talking about he was not talking about spoofing, but he was talking about actually buying. He was actually saying that if you can buy large amounts and then you can push up the price. Okay, so that's what he was talking about. Okay, but even that, whether it's spoofing or even what Gulati was talking about, actually buying and trying to push up the market, or actually selling and trying to push down the market. Okay, all these things are actually risky. There's no guaranteed profit, because in a large and open market like the foreign exchange markets are the most unregulated markets in the world. Okay, there's about the average daily volume. Does anybody have any idea what is the average daily volume in the foreign exchange markets? So it's $5.1 trillion per day. Okay, at its peak about 4-5 years ago, it was $5.3 trillion per day. So every day you have $5.3 trillion of activity in the foreign exchange markets, and more than 95% of that is speculative activity. Okay, which is something that need not necessarily be done. Okay, it's not that like Toyota Motor needs to buy some amount of euros to pay their suppliers in Europe. Okay, that's not speculation, that's just a hedge. Okay, or just a transaction for a commercial business. But we are talking about 95% of this 5.1 trillion volume is actually speculative. But you see the beauty of speculation. You see how tight the spreads are in the foreign exchange markets. Okay, this is what speculation does. It makes the market very liquid. So so understand this policy issue. This is an important thing to understand. Okay, that it should not be. I am also. This is of course my opinion. You can always disagree, and obviously the U.S. lawmakers have disagreed. Okay, and they have made spoofing illegal. Okay. But the point is that why are people saying that it should not be illegal? Either spoofing or what Gulati is saying, trying to manipulate the market by buying large amounts or selling large amounts. Neither of these should be illegal, because when you do these things, you are still taking a risk. Because when the market is free and open and unregulated, what happens is that anyone can come in. See, these foreign exchange markets, as you saw yesterday, they are moving round the clock. From Sydney, from Wellington, Sydney, Tokyo, Hong Kong, everybody's open at any point of time. There's no rule saying that just because New York is trading now, that City, Hong Kong night desk can't come and trade in that market. Okay, they can always do that. It's a free and open market. So in that kind of a market, the problem is that if you're trying to manipulate the market, you don't really know what the other guys are planning. You have no way of knowing who can come in at any point of time, right? So therefore, there's always a risk involved, because whenever you try to manipulate the market, or like as Sakshi was pointing out, you try to spoof and you place a huge sell order, and immediately bang, something happens and somebody takes those offers, and then suddenly you're short huge amounts where you had no intention. You were actually looking to buy. Are you following? So this kind of argument is very important to be exposed to. You don't have to agree with it, because in India you will never hear this kind of argument. In India, people are always afraid that there's going to be market manipulation. But market manipulation is only a risk when the market is closed and restricted in many ways. Like for instance, as you know, the Reserve Bank of India restricts foreign portfolio investors from investing in Indian debt securities, whether it's government debt or corporate debt. There's always some number, and the way they manage it is, okay, if they feel more comfortable, we'll raise it from 100 billion to 150 billion or whatever. But there is a cap. Okay, in a real free market, there's no cap. You can come in and trade as many dollars as, if somebody is willing to quote you a price, you can trade. Okay, so this is where the risk is. You try to manipulate. I just come to you. When you try to manipulate free markets, the risk of manipulation is much less in free and liquid markets, because there is less and less restriction on the number of players who can come in. So when you're manipulating, you don't know what anybody else might do. Okay, so that guy may be bigger than you. So he might come in and do something which is opposite to your intentions, and then you may end up in a loss. So therefore, there is always a risk involved in any kind of manipulation in a free market. Is this clear to everybody? It's important to understand this. Okay, all these points which we have covered: spoofing, layering, which is layering is nothing but spoofing at multiple price levels. Okay, spoofing, and also understand the policy debate around spoofing. And spoofing, and also we can connect that to what Gulati was talking about, trying to manipulate the market by buying or selling large volumes. To do that, you're still running a risk, because you don't know that you have no way of knowing that some other guy who's bigger than you will come and hit on the other side, and then you'll get into problems. Okay, so in a free market, Pretty much anything goes because there is competition and there's always risk, right? Okay, so it's kind of similar to if you follow tennis. There was a thing called a few months, maybe about a year back, there was Federer had started a new technique where on the second serve he used to come in he used to sort of come very close to the net. That was called like a sneak attack by Roger. The name was SABR, Saber, right? So people are saying that Federer is behaving unethically by charging on the second serve. Okay, but actually he's not behaving unethically because he's taking a risk. If he's charging forward on the second serve, the other guy can actually serve in a manner that, you know, makes it more difficult for him. So he's actually taking a risk. So if he's taking a risk, then it's not really unethical, because you know it's an open game basically, right? So a similar idea actually. Okay, so yeah, now let's go to Saloni's question. Yeah.
It won't be fair to the.
Do we have a mic?
Yes, yes.
Let's give her the mic. Yeah.
Yeah, this thing won't.
Mic is not working. The mic. What happened? Here they haven't switched it on here. No, it seems to be on. Yeah.
Sir, it won't be fair to other people, like if one person starts cooking and then other also start doing that, and like it's a both 2-3 people start cooking at same time, then it won't be fair to the other people. How will they get to know that this thing is going on? They might get trapped.
See, there are two levels. We can answer that. On the face of it, it seems that yeah, it's unfair. But understand that these things. See how quickly these things are changing. Do you notice when you're looking at the order book? Do you notice how quickly the levels are and the amounts are changing? Can you see that? And this is not even an active time. Okay, if you go into your notes and if you look at the market hours or under market hours, I'm pretty sure London has not yet opened. Okay, so the busiest time, if you look at, we are looking at the foreign exchange market. Okay, so you see how rapidly the amounts are changing and the prices are also changing as the price is moving around. There's no way to tell which way it will go. Okay, so now it's pretty quiet still. Okay, but prices are changing. So the point is that whoever is showing this price, like this 1 million at 136.5. Okay, now he is not bound by this price. He's always free to change the price. Okay, as long as but if somebody immediately hits what Sakshi is pointing at, if somebody has already taken the price, if somebody has already taken the offer, then he can't back out. Okay, but as long as he's offering, and remember in contract law there's also a concept of revocation of offer. Okay, I can give you an offer, you can buy this land, okay, at this price, okay, but as long as you haven't, as nobody's hit my offer, nobody has taken my offer, I can always withdraw the offer. Okay, I can say this offer to sell this land at this price is now revoked. Okay, so in contract law there is already the concept of revocation of offer before acceptance. Obviously you can't revoke the offer after acceptance, right? If the other guy has accepted your offer, then you're bound by it. But you can always revoke it before the acceptance has happened. So therefore, if you see here, these guys, when they are posting offers, every investor should have the freedom to change their mind. Okay, maybe you put this 3 million sell order here, but maybe some news comes out, okay, and then that causes you to change your mind to sell. You should have the freedom to revoke your offer. Okay, so this is consistent with the contract law principle of revocation of offers. Obviously subject to the rule that you can't revoke an offer which has already been accepted. Okay, this is clear. So does that partly answer your question? And the other, let me also give you another element of it, that in the sense that when I'm looking at these prices, okay, if I'm looking at these prices from various market makers, okay, and I'm a price taker, I already know that there's nothing guaranteed about this. See, when I'm a market participant, I already know that this 375 at 37.5, 2 million, this is just an indication at this point of time until I actually trade on it. Okay, the guy can change his prices. Same thing, that if I'm a player in the market, I know that all offers are subject to revocation before acceptance. This is nothing but that. So as a player, it's not that I have some immense faith that this price will be held for so long. Okay, unless somebody says, sometimes people say, Sometimes people give prices, but those are actually unusual situations. Sometimes when people are quoting for corporates, okay, we are talking about the interbank market. Okay, this is the professionals market. But sometimes when you are quoting for corporate customers, okay, say let's say Standard Chartered Bank Treasury is quoting a price to say Mahindra and Mahindra for some commercial transaction. Okay, maybe they want to send some royalty payment or something. So the Mahindra Treasury might say, can you hold that price for 15 minutes? Okay, so in that case, Standard might take a call on the customer relationship and all that. Even though there's some market price risk for them, they'll say, okay, fine, we will hold this price for 15 minutes. In which case, they can strike and accept that price at any time in the next 15 minutes. Okay, but that's an unusual situation. Normally in the market that does not happen. So you always understand that so you have to go back to that basic contract law principle. All offers are subject to revocation before acceptance. So it's consistent with that. So it's not really unfair, and every participant should know that these are not firm until anybody can change these offers and bids at any point of time. Is this clear? Is everyone clear? Okay, you don't have to agree with what I'm saying or what this CNBC article writer is saying, but you should understand the argument. That's the point, right? Because in India, you'll never see these kind of arguments. India is always, any hint of any problem, let's regulate. Okay, so I mean, the more regulation, the better it is. And the population is also inclined, things like that. If you see, population is also inherently socialistic. So they always think that more government control of everything is always better. So anyway, so we have covered some important concepts. We are actually just recapping. So as I said, London is not yet open. Okay, so we are now in a halfway house. Tokyo and Sydney have closed. Okay, but of course Singapore, Hong Kong, Zurich, Frankfurt, these guys are open. Frankfurt and all are 1 hour behind London. So if London is going to open in 35, which means Frankfurt and Zurich are all open already. So there is still liquidity in the market. That's why you see that the foreign exchange market, if you look at the prices, you see how tight the prices are. 37.1, okay, fifth decimal, all right. So you can see how tight the prices are. So that's because this market is pretty liquid from Monday to Friday. Monday opening in Wellington to Friday closing in New York. There's no real pause in this market. Okay, so what is our next topic? At any point, if you don't follow anything, you have to. So spoofing, layering, that topic has been covered, right? Okay, order books, top of the book, market depth, all right? So this is your market depth. Here you're seeing, here you see the market depth, right? See, here you can see all this if you want to go all the way back, but in general you want to stay close to where the market is, right? This is where the market is, right? Are you following? This is a display of the full market depth. All right, so the next topic is, okay, so you should also learn this term high frequency trading in this context, okay, because this is the context in which the spoofing and layering debate really comes up a lot. Okay, so HFT, the term is HFT, which stands for high frequency trading, which is nothing but, and these are your notes, so I'll just write it here, okay. And it's not going to look pretty, but we'll just make sure the information is just basically high frequency trading is just nothing but high in and out turnover. In and out, you understand? You buy and sell the same amount. Okay, that is just what I mean by this loose expression, in and out turnover. There's actually a burger chain in the US called In and Out Burger. Okay, so high in and out turnover in very short periods of time. Okay, so essentially very short periods of, which basically implies so this is basically what you would call a high volume. You heard these terms, high volume, low margin business. You are familiar with these expressions, okay? So high volume, low margin business kind of philosophy, okay? All right, this is the idea that you're not playing for, if you looked at what I was doing there as a directional speculator. So in many ways, market making is a high volume, low margin business. Okay, market making is expected to be a high volume, low margin business because you're not playing for big moves in the market. As a market maker, if you're in a reasonably competitive market, prices will be pretty tight. Okay, if you want to see some stable prices, you would look at the ones which are already closed. I don't know why they're not showing the bids and offers on these the US stocks, but anyway, so you can see that in a market, if you're looking at market making in Indian stocks, okay, pretty tight margins, okay, in the liquid stocks. Okay, so you're as a market maker, because you're looking to quickly, you're ideally looking for 50% of the transactions to be on the bid side and 50% on the offer side, and in a liquid market, bids and offers, the bid offer spread will be pretty tight. Okay, so your per trade margin is quite low. Okay, but you hope to make money by doing high volume, a very high volume of trading. Okay, so market making, if you want to use these stereotypes of a high volume, low margin business, okay, this kind of a stereotype, a market making business is that kind of business. It's meant to be a high volume, low margin business. Okay, so HFT in a way is also like that kind of business. Okay, if you look at this here, what was my plan as a directional speculator when I was buying TCS? What is my view? I was saying that it's at the minimum because this long uptrend is not over. It is going to go above 2,300. So I'm buying at 2,100, but I'm expecting it to go above 2,300, maybe 2.5 grand. Okay, so there's going to be a lot of profit per share. Okay, so I'm expecting a lot of profit per share. Here I don't need to have high volume because my margin in a sense is quite high for each transaction. Okay, so per share profit projection is quite high. So here I don't have to do it in high volumes. Are you following? Okay, so you can distinguish this in a way, the directional speculation business, which need not be a high volume business, because the margin in a way is quite high. The margin is used within air quotes. Okay, so you get the idea, right? So essentially, what is high frequency trading? This is what it is. If you look at this business, if you look at this order book, this gives you a very good idea of what high frequency trading is. Okay, these guys are trading in very large volumes. Okay, and they are not, even if they are not market makers. Okay, so high frequency trading could be both a directional speculator or a market maker. Okay, but this is a very specific type of directional speculator who is looking to make very small profits on very large positions. This is clear. That's what high frequency trading is. So basically you are not even looking to hold a position for in high frequency trading, like 5 minutes is like a lifetime. Okay, so 5 minutes is like a lifetime. So these guys are looking to get out positions within like 30-40 seconds. Okay, that fast. Are you following? Yes. So huge volumes, and try to quickly get in and out with very, very small profits, like maybe like half a cent. Okay, half a cent, or maybe like 25, like less than half a cent, and that kind of small margin. This is clear to you? Is everyone clear about this? Because prices are moving around quite sharp, quite rapidly, and in deep and liquid markets you can move large volumes. So you try to. So this is all that. I just want you to be familiar with this term called high frequency trading because it is thrown around a lot. Okay, so this is referred to as HFT. Okay, high frequency trading, and so here speed becomes very important. Okay, so maybe we should write down one more element here because you should be aware of this problem that we have in I'll just introduce one more element to this, which is high frequency trading. And so now everybody understands what high frequency trading is. It's nothing but that means your total transaction volume at the end of the day will be huge. Okay, it will be in billions of dollars because you're just trading in and out in very large volumes multiple times a day. That's why it's high frequency. Is this clear?
Same amount.
It doesn't have to be the same amount. Maybe first transaction is 500 million, next one is 400 million. Doesn't have to be the same amount, but large amounts. Okay, it has to be large amounts based on what you assess the market liquidity to be at that point of time. But it is basically, the idea is very large amounts, and you're trading in large volumes every time, and that's why you are willing to take even a small 2 paisa profit per or half a cent profit per transaction is also okay for you because your volumes are very big. This is clear. Okay, this is just a strategy. Yeah.
So is it same as when we execute the first order in the Q1 session of the market,
Yeah.
a bulk order, that is high frequency trading.
No. That's just bulk trading. Bulk trading that need not be connected. High frequency trading usually is not done through that kind of an organized system. It is done when the market is live and fluid and trading, normally. And then you go in and you decide to trade as a high frequency trader, because you can always decide to keep on buying, keep on selling, keep on doing. There's no restriction on the number of your trades as long as you're willing to put up the margin. So it's not something that would be done as such a because that's an organized process. That bulk trading, matching of bulk orders, yeah, that's not high frequency trading. Okay, that's a different kind of thing. So high frequency trading, now everybody understands, it's a big word, but this is basically all that it is. It's a high volume, low volume margin business, and you don't hold positions for very long. You keep on turning over your positions, 30 seconds, 40 seconds, that quickly. Okay, so time is of the essence. Okay, you understand this? Not just time, but speed. Okay. Do you understand why speed is of the essence here? Actually, we should have come back to this later. What I'll do is I don't want to, because I need to cover the essentials for your trading. I don't want to get into this topic right now. Okay, I'm just going to write it here. I'll cover it later. Okay, speed is of the essence. Okay, so let me just talk about SEBI and the co-location controversy. Okay, so essentially what happens, we'll discuss this later on at a point of time, because it's more of a policy issue, but you need to understand all these issues. But right now I'm more concerned with giving you the essentials for your trading project. Okay, so we'll come to this, but the point is that you see that in high frequency trading, speed will become very important, because I'm trying to get in and out, and you see the prices are changing. Okay, obviously now 6 million, 33 half. If I am not first in line to sell the 6 million, if I need to sell 6 million, somebody else will come in. Now she's already gone to 3 million, 1 million. Okay, so basically what's happening is somebody was ahead of me in the queue, because you're going to enter the order here, and like you, there are hundreds of investors all over the world who are entering orders, okay, through their systems. So these orders all get into a queue. Okay, so you have to be executed, your orders will be executed as on a first come first serve basis in the queue. So if you get late in the queue, then obviously your priority goes down. Okay, so because of this, speed becomes very important, and that's why there's this issue of, I'll just touch on it briefly, you can listen to it once again and read up on it a little bit. So essentially what happens is a lot of high frequency traders want to go for what is called co-location, which is basically nothing but co-location you need to have some idea of this client server technology. Okay, so what they're trying to do in co-location is they're trying to locate, because they want to get their orders to the exchange server very quickly, so they try to locate the servers near the NSE servers, that the exchange servers. Okay, so there's actually a case in India where 2-3 trading firms have been fined by SEBI. Okay, and this problem exists in the US also, because they tried to place their servers very close to the NSE servers in the NSE server room itself, wherever the NSE servers were located. You understand this client server technology?
Yes.
Okay, so if you are physically close to the server, because now we are talking about milliseconds. We are not talking about seconds also, we are talking about milliseconds, okay, or even smaller than that. Okay, so therefore you want to get the millisecond advantage over your competitor. So if you can be located closer to the NSE server or the exchange server, then your order will be transmitted faster to the server, because the queue matters only at the exchange server level. Are you following? Okay, you get the idea here. Okay, because speed is of the essence, because you want to hit the prices before it disappears. So this is the idea here, that there is this idea. So co-location is a term which is basically nothing but, co-location means locating your server near the exchange server. If I'm a trading firm, okay, if I'm SMC or another brokerage or Interactive Brokers, I want to locate my my speculative trading team, okay, which is engaging in high frequency trading. I want to locate their server, okay, close to the exchange server. Okay, their computer should be located close to the exchange server, so that when they transmit orders, they go quickly to the top of the queue. This is clear. Okay, so the physical location of the server actually makes a difference when you're talking about milliseconds. All right. So this is the idea behind co-location. So there's something else you need to learn as we are talking about all these things. These are all connected ideas. When you talk about order books, you try to see how markets operate, okay, bids, offers, getting hit here and there, okay, given, taken, and all that. And then you can see the idea of spoofing and layering, and then that brings in the idea of high frequency trading, and then connected idea is also the idea of co-location. Because high frequency traders always want to be located close, their servers should be close to the exchange servers. They basically want to get to the top of the queue fast. Okay, so this is a basic game, all right. But then many countries don't allow this kind of, they feel that now you're talking about an unfair advantage. Okay, so this is where there's a debate in the US also. Sorry. Now you're talking about an unfair advantage because some traders are getting in ahead of the rest of the, they're getting to the front of the queue very quickly. Okay, so there is a big policy debate around this, okay, about giving some traders an unfair, because those who went to the NSE servers, the SEBI's point was that SEBI fined these firms, and they fined the NSE also. Even the NSE was fined by SEBI, because their point was you gave these guys an unfair advantage by allowing them to be located next to your servers, which the other guys don't have, the advantage that other guys don't have. Okay, so this is something you have to be aware of. This is part of this entire topic that we are discussing, how markets operate, what are the policy issues that come up, etc. This is clear? Are you following? Anybody is lost? Yes, you are following? Okay, good. Okay, so all right, so let's go on quickly to, we are getting a little bit we are slowing down, because every time I cover a topic I want to cover all the related points, because otherwise you have a very stunted vision of that topic, you see. So it's very important to cover all the points, but I'm also pressured by the fact that your project is starting next week. I want to give you the essential toolkit. So if you feel that the coverage is a little bit helter-skelter, this is the reason for it, okay? That I am feeling the pressure to give you the essential skill set to do the to do your project. All right, so let's quickly go here. Short version. All right. So trading on quotes we have done, bids and offers. But are you feeling like you're learning something? Are you getting a feel of the whole markets environment, how markets operate? Chug is not convinced. Chug's expression is you're not convinced. Okay, now quickly let's go on to the next thing that you need to learn. Okay, data types. Okay, tracking markets using charts. Okay, let's cover this quickly. All right, this is our next subtopic. Even though charts are very simple, but we still need to let's try and make this more complicated. Okay, let's. All right. Okay, so in financial markets we basically plot two types of charts. Okay, you've heard of these terms: time series data, cross-sectional data.
Yes.
Okay, so if I take everybody's temperature in this room and I write down, okay, others 30 or whatever, 94, 98 degrees, okay, Hardik's 97 degrees, okay, I write all these figures down. Okay, I just took the temperature. This is what? What is this? This is cross-sectional data or time series data? Is my question clear? I take everybody's temperature in this room with a thermometer and I note down the values. So names and values of temperature. Then this is what? Everybody's not convinced. Shivam? Cross-sectional. You're just saying cross. Is everyone convinced? Yes? Yes? Cross-section, but you're not convinced. Okay, so this is cross-sectional data. Okay, so we're not going to cover cross-sectional data in detail at this point of time. Again, there's a lot of material to be covered under cross-sectional data in finance. Okay, there are many types of data plots, but again, that's not critical for our NSE trading project. So we're going to push that behind for a while. But you should understand this basic classification between cross-sectional and time series data. So this is cross-sectional. Look at how I've defined cross-sectional data. It's a very technical definition, but if you try to understand it, don't memorize the definition, but try to understand it. Cross-sectional data is, read it. Okay, so if I take the other point about cross-sectional data is that the order of observations are not relevant. If I take everybody's temperature and then I can just write, whether I write Adarsh's name first or write Hardik's names first, doesn't make a difference, because it doesn't change the information being provided. Okay, because all you need is the name of every student and their temperature. Okay, this is clear. Now when you look at time series data, you understand why order of observations is relevant. But first, understand cross-sectional data. Okay, why it's what is the technical definition of cross-sectional data, because it's not easy to find them defined in this manner. But if you remember, understand the technical definition. Cross-sectional data is always snapshot. Okay, so essentially the picture that Parul took yesterday of the class, that's also cross-sectional data. At that point of time, whoever is present in the class is shown. Okay, but we don't know after 15 minutes who was present in the class, that we don't know. But we know that that point of time, these are the people present in the class. So that's also cross-sectional data. Okay, so slightly unusual presentation of data. But so what are we saying? Therefore, what is the critical property of cross-sectional data? At least two variables and one point of time only. Right? So you can have like 50 million variables. You can have 50 million people, and you can note down their monthly salary. Okay, at any point of time, because monthly salary can also get revised upwards, downwards later on. But any point of time, monthly salary of 50 million people, that's also cross-sectional data. Okay, so clear. So therefore, order of representation. Now time series data. So I'm actually making it very easy for you. So is this time series data or cross-sectional data? Time series data. Okay, because this is the price of TCS common stock over time. All right, so if you make this like, if this right now I've got this as if you want to make it really simple. Okay, I've made it a line chart. Okay, so now you can see how is this chart derived. This is the time series data. This is time series data because essentially it's the plot of, now look at the definition of time series data. At least one variable for at least 2 points of time. Okay, the reason I say normally when we look at time series data, it is just one variable. Okay, but I've written at least one variable because even a comparison is still time series data. Okay, so if I do this for instance and then I compare, let's say, so understand this definition first. In a way, to some extent you have to memorize it, but don't memorize it like an idiot. Like, memorize it while understanding it. Okay, understand why it's given there. Don't just switch off your brain and memorize it. Okay, but why is it like this? At least one point at cross-sectional data, you have at least one variable for at least 2 points of time, because that if you have only one point of time, then you don't have time series data because there's no series. This is clear. So when you understand the name, then it's clear that it's time series. So there has to be at least 2 data points. Otherwise, there's no series. But even 2 data points technically is a series. Although we don't normally plot for only 2 data points, but the point is that the technical definition has to be given in a legalistic manner, which means that it should capture all the situations where that definition applies. All right. So technically, even if I plot 2 data points, that is also time series data. Today and tomorrow. Okay, time series data. So so is this clear to everybody? Now understand that there at least one variable for at least 2 points of time. Okay, and that's why I said ideally multiple points of time. Order of observations is relevant. Do you see that point here? Can you see that the order of observations is relevant? Because take the last observation is 2115 and the first observation, let's say, is 1975. Now if I change it around and I put 2115 here and 1975 here, will it change the chart? It will change the chart. So the order of observations is, it's important to, it's relevant in the sense you have to maintain the correct order of observations. Otherwise you're not giving the right picture of the data. So we are using this expression, order of observations is relevant, to make a distinguish between time series data and cross-sectional data, because in cross-sectional data, order of observations is not relevant. This is clear. And in time series, this is relevant. Is everyone clear about what I mean by relevant? That you can't just, in a time series data plot, you can't just jumble up the order of observations, because that will change the meaning of the because right now this is the truth. This is the actual truth of how TCS stock has moved over this period. Okay. Now, if you just jumble up the order of observations, you put this data into Excel, then just resort the data and then plot another chart. Now, that's not the truth anymore, because that's not how the stock price moves. So you have to maintain the correct order of observations. Is everyone clear why we make this statement? That gives us a useful way to distinguish between time series and cross-sectional data. This is clear? Okay. So order of observations is relevant. At least one variable for at least 2 periods of time. Okay, and ideally multiple. Now, why did I say at least one variable? Because if I go to compare or add symbol and I say I want to compare the movement of TCS to the movement of the Nifty 50. Alright, now you can see this over this period. The Nifty 50 is this is plus, or maybe it's just plus 3.25, and TCS is plus 12.95%. This is clear? So we are comparing the two. We are trying to see whether how has TCS performed relative to the broader stock market. The Nifty 50 is being taken as an index of the broader stock market. Okay, so the point to understand here is that although normally we plot time series data only for one variable, okay, but the reason I've given you the definition as at least one variable, because if I give you the definition as one variable only, if I don't put in that at least word in the definition, if I define one variable for at least 2 points of time, then you will say that this is not time series data, because it's not one variable, it's two variables. Are you following my logic? Okay, so the definition has to be always broad so that it must always be correct. Okay, so this is still time series data, because you're plotting two variables, but it is still over a period of time. Okay, this is not cross-sectional, this is time series data. This is clear to everyone? Okay, are you following? So basic terminology, but you want to be clear. There's a reason it's very, I don't think you'll find this anywhere, this kind of very strict definition, but this is how you should learn a subject. Okay, that's why I've written these definitions in a strict way, that when you learn it in this strict way, the concept is 100% clear in your head. So you make sure you understand the concept. Do not memorize, okay? Do not switch off your brain and memorize. There's some element of memorization, okay? But you make sure you understand the concept so that you can work it back logically, okay? If you ever forget it. All right. So we want to learn some basic terminology about charts. Okay. So there's also another term here called panel data, which is a social science, which you hear in social science research. Okay. Essentially, it's basically, the time series data is connected. It's similar to time series data. But this panel data term is not used in financial markets. So, and we are studying financial markets charts. But once again, I gave you this information because I have to always tell you everything that is connected to the idea we're discussing. Otherwise, you have a very stunted vision of the idea. Okay. So if you one day hear what is panel data, is actually similar to time series data, but we use it in a social science research context, not in the financial markets context. Okay. Now quickly, let's go through stock concepts versus flow concepts. Do I have time for this? I'll come back and do this later. Okay. I'm going to write that this is not covered because I'm a little panicky about the amount of time I have left, and I need to equip you with the skill set because your trading starts from next week. Is everyone clear about what they have to do? The responses are not convincing. Is everyone clear about what they have to do? They have to try and buy and sell stocks. Generally, some of the time, you might find that when you try to sell something, you might find that if you try to sell TCS, you might find that I just hit the bid because I want to sell. Okay, if I want to go for a market sell order, maybe if I want to go for $5,000 shares, if I want to sell, sometimes you might get a message saying that doesn't matter. Okay, here you don't get this message. Okay, but sometimes you might get a message saying you see how it's filling the order. I think I've switched off the sound, that's why you don't hear this message coming up, but it's filling the order. Can you see that? Slowly the position size is increasing, the short position. Okay, sorry, this is I think yeah, So it's filling the order. Now the point is that sometimes you might get a message saying that shortable stock is not available, because understand this, that you don't have to first buy it to sell it. Okay, we'll explain this in detail later, but understand this as basically you can actually go short. This is called short selling, where you don't have to have, now you sold 5,000 TCS total. Okay, you can see here, you can see the breakdown here. You can look at how many trades had to be done to come to 5,000. Okay, you can see all these trades, all right, all these trades that have been done, and you can see your total commission also. All right, the point is okay, so the point is, sometimes you might get a message saying shortable stock is not available, in which case you can't go short. Okay, so the point I was trying to emphasize here is that is, if you see, we can close the flash crash video now. We can close the foreign exchange market video as well. I mean this chart. Okay, the point I was trying to emphasize here was that, I'll just remove this also. All right, the point is that you don't have to necessarily buy. Okay, the point that Kurtu was mentioning yesterday, that the market keeps on falling. Okay, the stock market keeps falling, and so whatever we are buying, the positions are going into losses. But if you have a bearish view on a particular stock or on the market as a whole, okay, in here you're trading individual stocks. If you have a bearish view on the stock, you should just try to sell it. Okay, just I mean, I don't have a bearish view on TCS, but I just sold it just to show you. Okay, that you can actually start out by selling as well. So we'll understand the mechanics of short selling later. If you want to understand it, there's nice explanation on the Interactive Brokers website. You can check that. The website is very good. You can explore that website as well. So the point is that, get this out of your mind, that you have to first buy it before you would sell it. You can go short as well. That's just going short selling. Okay, in the stock market. So you are going short. So if you have a bearish view for the purposes of your project, if you have a bearish view, try to sell it. If you find that the stock is not available for short selling, okay, then obviously you can't do anything. Then you just, the next best thing to do is don't buy at least. Okay, so if you have a bearish view, the best thing to do is to go short. But if the stock is not available for short selling, we'll explain later what that means. That means essentially that you can't execute the short sale. In that case, the next best thing you can do is at least don't buy it. Stay away from that. Okay, so if you have a bearish view on TCS, you try to go short, but if you can't go short, at least don't buy it. Buy something else where you feel a little bit bullish, or you at least don't feel so bearish. This is clear? So you have an operating rule. Okay, now you may not understand a lot of the stuff, so what will happen to you in the course of this project is that you will find that you may feel like you're just being thrown into the water and you don't know how to swim. Okay, so as I might have explained to you earlier, that this is inevitable because of the structure of the curriculum. Okay, we don't have, ideally what would happen is I would teach you all this theory in the first year, and then in the second year we would do all these projects, and then you can have more sophisticated discussions based on your foundational knowledge. But that's not how the curriculum is structured. Okay, so therefore basically what's happening is you are learning to you are just being thrown in the water. It's like I'm throwing you in the water, and then I'm showing you from the side, I'm showing you, look, here is the book on swimming. Okay, so this is basically what's happening, but this is something that you have to accept. So you may feel uncomfortable, okay, but accept this as basically we are constrained by the time that we have in the program and the overall structure of the curriculum, because the material you're studying in the first year is different material, is different kind of material. Okay, so we don't have, so I'm having to, so this is just, but I think it's still useful if you just keep this idea in your mind, what I told you. Okay, let's try and look at go for if you just keep this idea in your mind, what I told you about basically looking at it as a surfing exercise. Okay, you don't need to read a book on physics to learn how to surf. Okay, you can just go there and take a surfboard and just teach yourself how to surf without any guidance, just through your own gut feel, right? You can do that, right? In the same way, think of it as surfing. It's a simple approach to the market, and it's actually quite a sound approach, as long as you always apply your stops. Always put stops on every trade, which means the idea must be that every trade is just a gamble. And so therefore on one gamble you should not lose a huge amount of money. So make sure your loss, the maximum loss on any trade, is limited to a reasonable amount. You have $1 million in your account, you can, let's say, assume that you can grow up $1 million. So that should be, you should not blow up $1 million on one trade. So you should carve it up, okay, and then bet in small lots so that you can lose on many trades and still be able to play, right? Is this clear? Okay, it's like when you go into a casino and you have $10,000, your plan is that, okay, I'm going to blow up $10,000, okay, but then you don't go blow up $10,000 on the first bet, okay, so you would carve it up maybe into, you know, $500 lots, okay, and then keep betting $500 and see if you strike it lucky, right? So the same concept applies here. As I told you, those artificial concepts that you hear about you know, investment and speculation, those are all garbage. They are based on a poor understanding of life and a poor understanding of markets and economies and risk. Everything is speculation. There's no such thing as investment as opposed to speculation. Everything is speculation, okay? So, and therefore there is a professional way to speculate, and the professional way to speculate is this way. You decide how much you're going to the casino with $10,000. You're ready to lose $10,000. You're not going to have a heart attack if you lose $10,000. Okay, so you are ready to lose it, and then you go in there and you systematically carve it up into $500 lots, and you keep betting, and then you see what happens. Okay, so that this is what is professional speculation. So everything is speculation, but you have to speculate in the professional way. This is clear? Are you getting the message? So if you just approach this market from a surface perspective, but keeping risk management in mind, it's a very solid and legitimate approach, and it's a very simple approach. So you can apply that. Okay. So what are the things you have to do? Let me try, because this is our last session. So from Monday onwards, you start trading in your live project account. Okay. So is every team here? Every team is represented here? Okay. So please, then what you have to do is make sure that by this weekend, okay, you send me an email as to which is your, give me the particular login ID. I've given you 3 or 4 login IDs. Okay. So which login ID is going to be a project trading account? Okay. Please email that to me. All the team leaders or somebody from the team mentioning the team leader's name should email that. Is everyone clear about that? Yes. I'm not going to separately send you an email on this. Send me that information on which is going to be your trading account, because that should be declared beforehand. Okay. So then, all right. So what are we going to do now? Quickly, stock concept versus flow concepts. I'm going to discuss later because I don't have time. Not covered, okay. Okay, so I have about 12 minutes. Now I'm trying to just quickly see what else I have to cover. All right. So now, guys, we are plotting we are covering the other important part which we have to at least cover now. I think decision problems I'll have to eventually do. Okay, let me do this here. Let me just at least give you a full rundown on what you're going to do. Okay. Is everyone following so far? Anybody confused? Okay. So as I said, you will feel that it is a little bit, you know, rushed, but life is confused. Light is confused. Okay. I'm going to come to this some type of plot. Okay, let me just do candles. All right. Okay. So, all right, guys. Now this is what you're going to do. Okay, you're going to go. Let's. This part of the presentation is very important because I'm trying to quickly sum up for you. Okay, how you're going to approach the project. Okay, so you have the entire list of Nifty 50 stocks. Go to the NSE website. Take out the Nifty 50 stocks, okay? And in programming, I don't know if any of you guys have ever done programming. There's a concept of repeat and repeat. Okay, so whatever logic I'm telling you for ITC as one stock, so you pick one stock, you apply this process to that stock, then end that. When that is done, then you go to the next stock and keep on repeating the same process for all the stocks. Okay, so I pick out ITC as my first stock. Okay, and then I have to form a view. Am I going to be a seller or a buyer? And that view is based on, at this point of time, It's just going to be, because you can always apply. I mean, I don't have the time to teach you a fundamental analysis at this point of time because it's quite a body of material. Okay, but if you are comfortable with fundamental analysis, you can always listen to the TV programs and follow the coverage of ITC, look at their financial statements. You already have done all these financial statements in your first year. Okay, so if you want to apply some of that type of analysis, which is typically what people do when they talk about stocks. Oh, ITC is going to do very well because Chug is going to start smoking 6 times a day now. So business is going to start booming. Okay, so do this kind of analysis. Okay, and then you decide to buy ITC. Okay, so this is fundamental analysis. Okay, this is what fundamental analysis is. Okay, all right. Now, what I've taught you is technical analysis. Okay, which is just not worrying about, you don't even know what ITC sells. Okay, you just see this thing. Okay, this is called ITC, and it's going up and down, and I just take a view on whether it's going up and down like a surfer. Okay, whether it's going to go, which way is it going next? Okay, a surfer doesn't know anything about fluid mechanics. It just takes a call. He just takes a call on which way the wave is going to come. Okay, so that's all you're trying. That's a technical view approach, which is a very simple approach. But if you want to take a fundamental analysis approach, you're free to do that. Okay, so either by using technicals or fundamentals, you form a view. Is this clear? So I form a view here on ITC. My view is that, let's say it's going down. All right, my view is going down. So now immediately what I will do is, now this is a slightly longer term chart, this is a daily chart. See how I'm approaching it. Then this is the purely technical approach, because in fundamentals anyway you can't be so specific. Okay, so immediately I'm going to go short. All right, so I need to place a stop. That's my next question. Okay, I'm trying to make it very, very simple. Okay, my first decision is basically whether I want to buy or sell, because the universe of markets is decided. We will study decision problems in a more formal way later on, but I'm trying to really compress it here to just what you need. Your universe is clear, Nifty 50 stocks. Whatever I'm doing to ITC, you will have to go and repeat it for all the stocks in the Nifty 50. Same logic. Pick up the chart, take a view. I look at this, my first instinct is I want to sell. Okay, so I will, and to make it very simple, I'm going to sell at market. Okay, so we'll discuss about market orders, limit orders later on, but I don't want to complicate that decision about the entry price. I'm going to make it very simple. I'm going to sell at market. Okay, so I'm going to sell at market, but at the same time the next question then becomes, so my decision to buy or sell, which Aurora was wondering about, how did I decide to buy or sell, that here I just look at the chart and my instinct says sell. Okay, and then obviously I have to set a stop. So selling now, I know which side of the market I'm on, I have to set a stop. I can't see very clearly here. This is a daily chart. This is too, the zoom is too far away. I need to zoom in. Okay, I'm going to zoom into this part here so I can set a tight stop. Okay, one stop I can set is market is at 270, I go short at 270. Okay, one stop I can set clearly is at 311, 312 here, this high. Okay, I can set that stop. But my problem is 270 to 311, that's too much for me. Okay, I want to sell a reasonably large volume. I don't want such a wide stop. I want to see if I can get a tighter stop. Remember these terms?
Yes.
Wide stop, tighter stop. So one option straight away is 270 to 311. That's my stop. 311 is my stop. But I don't want such a wide stop. I want a tighter stop. So that what I'm going to do is I'm going to zoom in here. Okay, so I'm going to make this. I'm going to increase the granularity. Now I'm using some terms which we'll cover later. This is called granularity. I'm increasing this. I'm going from 1 day to I'm going to 15 minutes. So I'm increasing the granularity. Okay, so I'm zooming in. Okay, now you see here this is that 311 high. Now I can see a lot more detail. Okay, so extreme case, what I can do now, I have two better options. I don't want such a wide stop. Okay, I can either place my stop here around 275. You understand which one I'm pointing at?
Yes.
Either I can place it here or I can place it here. Okay, both of them are much better than 311. Okay, so I think I'll just place it here. Okay, 275. In practice, what I will have to do is I'll have to read, zoom out, and going to roll my cursor here and position it. You see how the numbers are changing?
Yes.
I read the high here. The high is 275.10. Are you following where my cursor is? The high is actually 275.10. The system can show you is showing you the things. Okay, so you can take any charting software. You can use Money Control for longer term charts. So 275.10, and here they're trading in 15 minutes, 5 paisa increments. So I will set my stop at 275.11. Sorry, 275.15. See, this high is 275.10. You see the high? O is for open, high, H is for high. Can you see that? 275.10. So my stop trigger is 275.15. Okay. Okay, we still have 5 minutes. I'm going to quickly give you this information. Okay, so what do I do is immediately I sell ITC. Okay, I'm just going to sell 100 so that I save some time. Okay, how much will I sell? That will come to later. Okay, immediately I sell it. Okay, I sold it. Now I have to set an order. No, I don't want to open order entry. It's very complicated actually. Let me just set a buy. Okay, so this sell, this red thing, just forget about it. This already executed. The order is already executed. Okay, now I'm putting a buy order. What I'm going to do is I'm going to set my stop. Okay, remember I have to set my stop. What is the figure I read off? 275.10, but actually I have to set it at therefore higher than 275.10. So I'll set it at 275.15. Okay, is this clear to everybody? Because it has to go higher than 275.10. Okay. Now what I do is I set a buy order. See, that sell thing has disappeared. Now I want to buy order, make sure it's for the same position amount. I sold 100, so this buy is for 100. Now this will be a stop order. This will be a stop order. Okay, this is going to be a stop order, and this price, the stop price, this has to be edited to 275.15 is what I said. Okay, is this clear? I set a 275.15 stop order and I transmit. Okay, assuming that yeah, this is all kinds of warnings. We'll just override and transmit. Okay, so the order is now live because I got a green signal here. Okay, the order is live. So now you see what I've done. Very quickly I've moved through some very important decisions. Okay, first, this few decisions I already made for you. Which asset class? Equities. What type of instrument? Spot. Okay, which markets? Only NSE Nifty 50. No Toyota Motor trading on Tokyo Stock Exchange. No, none of that is allowed. I have made some decisions for you. Asset class, market, instrument. Equities, Nifty 50 stocks, instrument is spot type. I made those decisions for you. Then you have to make the decisions about buy or sell. Okay, you look at the ITC chart, you pick out ITC as the first stock, you look at the ITC chart, you form a view based like a surfer, you form a view that is going down. Okay, then immediately you sell at market to make it simple. Okay, if you wanted to sell at a better price, you would have placed a limit sell order. We'll come to that later, but right now simply you sell at market. Okay, and then you have to place a stop. Okay, so your stop is at 275.15. So now what I've done is, now my per share risk is capped at 270 to 311, or no, not 311, where is it? 275.15. So my per share risk is 275.15 minus 270. Is that right? Yeah. Is that correct?
Yes.
Is everyone following this? Verma? Okay. 275.15 minus 270 is my per share risk. Is everyone clear? Assuming that the stop is executed at 275.15 itself, it may end up getting executed at 275.20 or 25. Okay, but let's assume that it's going to get executed. So my per share risk is 275.15 to 270. Okay, so 515 is my per share risk. Okay, now I come to the other important question of how much do I want to no, just 1 minute. But how much do I want to sell? I'll just give you a quick summary. How much do I want to sell? Okay, now I have $1 million in my account. Okay, as a thumb rule, what you should do is maybe just you can start with 1%. Okay, you don't want to risk more than 1% per trade. So you need a total of 100 losing trades in a row to blow out your whole capital. You take $1 million as your capital, equivalent of that, and convert it into rupees as your capital. Okay. So as a thumb rule, we'll come to that discussion later on. As a thumb rule, you say that I will not risk more than 1% of my total capital on each trade. So 1% of $1 million converted into rupees. Okay, see the rupee balance, and then 1% of that is your per trade risk. Okay, so now the question of how, remember, this still has to be decided. This is a default figure, 100. This position size also has to be decided actively by you. You don't just take the default in the system. Okay? How will you I'll just finish. Just give me 2 seconds. Okay? We have already done this exercise once, remember? It's in your calc file. How will you decide this? Figure out what 1% of $1 million is. Okay? Suppose that figure is X. Okay? Then divide that figure X by, what is the risk I defined on this trade? 5.15. I define the risk as 5.15 per share risk. So how many shares to sell? Is that X divided by 5.15? This exercise has already been done in one of your previous classes, and the calculation is in your spreadsheet. Have you got the logic?
Yes.
You understood the logic?
Yes.
Okay. So 1%, why 1%? Now you can say why 1%, why not 2%? We'll come to that later. At the moment you just work with the 1% guidance. Okay. Mainly it's meant to be a very low figure. Okay. That's all it means. Okay. So is everyone clear? Now you have the guidance on what you have to do.
Yes.
You have all the decision rules, and then you keep on repeating. Suppose you go short and it keeps on going down. Now you have one decision to take on a daily basis. You keep on maintaining the short position for as long as you feel bearish. Remember, this is the bearish view. So you keep looking at the chart all the time, several times a day. And so the other question that arises, when should I exit my position? Suppose the stock, you've gone short and you're making money, keeps on moving down. Okay, just repeat the same analysis. When you no longer have a bearish view, then you should exit your position. Okay, we'll give you more refinement on that later on, but for now you can start with this. Is this okay?
Yes.
All right, good. Please make sure everybody subscribes and gets notified. Pick up, watch the videos, make sure you internalize all this learning. Whatever we have covered in the class, nobody should ever forget it in their lifetime. Is this clear? Should be totally embedded in your brain. Okay?